$65 billion, 17 consecutive years, 4,800 client accounts, every one of them fake. On the 11th of December 2008, the FBI arrested Bernard Madoff in his bathrobe. A whistleblower had been warning the SEC for 9 years. The SEC had done nothing. At 8:30 in the morning on Thursday, the 11th of December 2008, two plainclothes FBI agents walked through the lobby of a pre-war Upper East Side co-op on East 64th Street in Manhattan, took the elevator to the penthouse, and rang the doorbell. The man who answered was a 70-year-old former chairman of the NASDAQ stock exchange, founder and chief executive of one of the largest broker-dealer firms in the United States, a member of the Board of Governors of the Securities Industry Association, and one of the most respected figures on Wall Street. The lead agent told him, politely, that they were investigating an allegation of investor fraud and asked if he had an innocent explanation. The man said quietly that there was no innocent explanation. He was arrested in his bathrobe. The man was Bernard Lawrence Madoff. The fraud he had just confessed to was, as of that morning, the largest Ponzi scheme in the history of finance. $65 billion of fabricated client account balances spread across 4,800 client accounts. 17 consecutive years, at least, of completely fictitious investment returns. The cash actually lost by Madoff's investors, when the trustee finished his accounting, would settle at approximately $17 billion. The remaining $48 billion had never existed at all. Statements mailed, returns reported, audits signed. None of it had ever been traded. For 9 years, an independent financial analyst in Boston named Harry Markopolos had been writing letters to the Securities and Exchange Commission explaining, in 19 pages of detailed mathematical proof, exactly how the scheme worked. The SEC had read the letters. The SEC had filed them. The SEC had done nothing. To understand how the largest Ponzi scheme in financial history could remain undetected for at least 17 years, one has to understand the man at its center, because the central insight of the Madoff fraud is that the perpetrator was, for most of his life, not pretending to be a respected member of the financial establishment. He was one. Bernard Lawrence Madoff was born in Queens, New York, in April of 1938, the son of a former plumber who had reinvented himself as a small-time stockbroker. He attended Far Rockaway High School, graduated from Hofstra College in 1960 with a degree in political science, and on the 18th of November that same year, using approximately $5,000 he had saved working summers as a lifeguard on Long Island, plus a loan from his father-in-law, he founded a small over-the-counter market-making firm in Lower Manhattan. The firm was called Bernard L. Madoff Investment Securities. He was 22 years old. He had been married for less than a year to his high school sweetheart Ruth, a former student at Queens College and a quietly capable bookkeeper. For the next 3 decades, Madoff built that firm into a legitimate, technologically pioneering operation. By the early 1980s, he was one of the first firms to fully computerize the matching of buy and sell orders in over-the-counter stocks. By 1989, his firm, 20 traders dealing in the top 250 NYSE-listed names, was already handling about 2% of the share volume on the New York Stock Exchange. By 1992, that share had climbed to nearly 10%. Between 1990 and 1993, he served 3 separate terms as the chairman of the NASDAQ stock exchange. When the Ponzi began, and the precise year that it began is, even now, contested by federal prosecutors, Madoff was not an outsider trying to break into Wall Street. He had been Wall Street for the better part of his adult life. The physical architecture of the fraud, by the late 1990s, was housed on 2 floors of a single building in Midtown Manhattan, 885 3rd Avenue, between 53rd and 54th Street. A 34-story tower of red, brown, and pink granite, designed by Philip Johnson and John Burgee, finished in 1986. Known to everyone in New York as the Lipstick Building for the cylindrical setbacks that made it resemble a tube of lipstick rising from the sidewalk. On the 19th floor was Bernard L. Madoff Investment Securities, the legitimate market-making business, 300 employees, Bloomberg terminals on every desk, real trades, real revenue, real audited financial statements. On the 17th floor, accessible by a separate restricted access elevator, was a much smaller operation, run by a much smaller team. Officially, this was the investment advisory arm of the firm. In practice, the 17th floor was where the Ponzi was operated. 24 employees. No real trading activity. A single antique IBM AS 400 computer used to generate fictitious account statements. The chief financial engineer of the 17th floor was a man named Frank DePascali, a high school graduate from Queens who had joined Madoff in 1975 as a clerk and had never worked anywhere else. By the late 1990s, DePascali's job was to fabricate every month several thousand investor account statements showing trades that had never been executed, on prices that had been backdated to look plausible against historical market data. Bernie Madoff himself, in his later confessions, would describe the operation in one sentence. The 17th floor was a fiction, but the fiction had to be perfect. The investment strategy that Madoff claimed to be running on the 17th floor had a specific name and a specific structure. He called it the split strike conversion. In genuine financial markets, a split strike conversion is a real and legal option strategy. The investor buys a basket of large capitalization stocks, typically the 30 to 50 largest names in the S&P 100 index. Simultaneously, the investor sells call options struck above the current price of those stocks and buys put options struck below. The combination locks in a defined upside, a defined downside, and a steady stream of premium income. The strategy is well understood. It produces modest, low volatility returns, typically 4 to 6% annually in a bull market. In a flat or down year, it can produce essentially zero. Madoff's 17th floor accounts, year after year, reported returns of 10 to 12%. Net of fees, with almost no down months, across 2 decades that span the 1990 recession, the 1998 long-term capital crisis, the 2000 dot-com crash, the 2001 World Trade Center attacks, the 2002 corporate fraud aftermath of Enron and WorldCom, and the 2007 subprime mortgage shock. Through all of it, Madoff's accounts produced the same gentle upward line, between 5 and 12 basis points of variance per month, year after year after year. Any quantitative analyst who studied the reported returns for more than a few hours could see, plainly, that no real option strategy in the world could produce them. The market did not move that way. The strategy did not work that way. The numbers were not possible. The first person in the financial industry to perform that quantitative analysis and reach the correct conclusion was a 33-year-old options strategy researcher in Boston named Harry Markopolos. Markopolos was, by his own description, an obsessive personality with a Mediterranean stubborn streak and an undergraduate degree in business administration from Loyola College in Maryland. By the late 1990s, he was working as the chief investment officer of a small Boston firm called Rampart Investment Management, which was a direct competitor to Madoff in the split strike conversion business, the difference being that Rampart actually traded the strategy. In 1999, Markopolos' boss asked him to design a competing product that could match the returns Madoff was advertising. Markopolos took 4 hours to conclude it was mathematically impossible. He spent the following 9 years trying to convince the federal government of that fact. In May of 2000, Markopolos submitted his first written complaint to the Boston Regional Office of the Securities and Exchange Commission. 8 pages with mathematical appendices. No response. In November of 2005, by then his third formal submission to the SEC, Markopolos filed a 19-page memorandum titled, in its actual heading, "The World's Largest Hedge Fund is a Fraud." It listed 29 specific red flags, ordered from highly likely to almost certain. The memo named Madoff. It listed the address of the Lipstick Building. It named the major feeder funds, Fairfield Century, Kingate, Tremont. It explained the mathematical impossibility of the reported returns. It estimated the size of the fraud at, conservatively, $30 billion. The SEC's New York regional office opened a file. They sent 2 examiners to Madoff's office. The examiners, by their own subsequent admission to the Inspector General, did not understand the split-strike conversion strategy. They asked Madoff for documentation. He gave them documentation that they did not have the technical expertise to evaluate. The file was closed without action in January 2006. What ultimately broke the Ponzi was not the SEC. It was the failure of Lehman Brothers. Like all Ponzi schemes, the Madoff operation depended on a steady ratio of new cash arriving to old cash departing. As long as new investments exceeded redemptions, the 17th floor could pay any client who wanted to withdraw their money, using the new cash from the next client coming in. The fictitious account balances were never tested against reality. Between the 15th of September 2008, the day Lehman Brothers filed for Chapter 11 bankruptcy, and the first week of December that year, Madoff's investors, panicked by the broader financial crisis, submitted redemption requests totaling approximately $7 billion. Madoff did not have $7 billion. The 17th floor at the Lipstick Building, on the morning of the 8th of December 2008, had approximately $220 million in cash. The rest of the $65 billion in client statements had never existed. On the evening of the 10th of December 2008, Bernie Madoff called his 2 sons, Mark, 44, and Andrew, 42, both senior executives at the firm's legitimate 19th floor business, into his apartment. He told them the investment advisory business had always been a Ponzi scheme. The fraud was over. The sons, with their lawyer, contacted the FBI the same evening. The agents arrived at the penthouse the following morning. Bernard Lawrence Madoff was arraigned in federal court in Lower Manhattan on the same day as his arrest. He was released on $10 million bail, secured by his Manhattan penthouse and his Palm Beach home. On the 12th of March 2009, 3 months later, he pleaded guilty to 11 federal crimes: securities fraud, investment advisor fraud, mail fraud, wire fraud, 3 counts of money laundering, false statements, perjury, false filings with the SEC, and theft from an employee benefit plan. He waived his right to a trial. He named no co-conspirators. On the 29th of June 2009, in the same federal courtroom, Judge Denny Chin sentenced him to 150 years in federal prison, the maximum possible sentence on the 11 counts, calculated to leave no possibility of release in his lifetime. Madoff was 71 years old. The sentence was widely understood by the financial press as symbolic restitution to the victims rather than literal punishment. He would die in custody. The federal trustee appointed to recover assets for Madoff's victims, a New York attorney named Picard, would eventually distribute approximately $14.5 billion back to defrauded investors through a decade-long sequence of clawback lawsuits against the Ponzi's net winners. The recovery rate against the $17 billion in actual cash lost was approximately 72%. By the standards of financial fraud trustees, it was the most successful recovery in American legal history. Bernie Madoff died at the Federal Medical Center in Butner, North Carolina, on the 14th of April 2021 at the age of 82. The collateral damage to Bernie Madoff's family was, by any normal measure, total. Ruth Madoff, the high school sweetheart he had married at 21, surrendered virtually all of her assets in a 2009 civil settlement with the federal trustee. She was permitted to keep $2.5 million against household assets and investment account balances that had been estimated on paper in the hundreds of millions. She moved to Connecticut. She was, by all subsequent reporting, not aware that the Ponzi existed before her husband's confession. On the 11th of December 2010, the second anniversary to the day of his father's arrest, Mark Madoff hanged himself in the living room of his Soho loft, while his 2-year-old son slept in the bedroom upstairs. He was 46 years old. He had not spoken to his father since the confession. Andrew Madoff was diagnosed with mantle cell lymphoma in 2012. The cancer had first been diagnosed in 2003 and gone into remission. Andrew told reporters that the stress of the post-2008 fraud aftermath had triggered the recurrence. He died on the 3rd of September 2014 at the age of 48. Frank DePascali, the chief financial engineer of the 17th floor, who had cooperated extensively with prosecutors after his own arrest in 2009, died of lung cancer in May 2015 before he could be sentenced. Of the senior figures inside the Lipstick Building on the morning of the 11th of December 2008, the only one who lived to see the financial restitution process complete was Ruth Madoff. She is, as of this writing, 84 years old. The Madoff Ponzi was not, in the end, a story about one charismatic con man. It was a story about institutional failure at every layer that should have caught him, and didn't. The SEC's own Inspector General published a 477-page post-mortem in August 2009. 5 separate times, 16 years. The SEC was warned in writing. The first time they didn't investigate. The second time they did, and didn't understand what they were looking at. Twice they wrote internal memos saying the strategy was suspicious. Then they closed the file anyway. Harry Markopolos, who in the years after the collapse turned his attention to other suspected frauds and built a private practice as an SEC whistleblower bounty consultant, would summarize the lesson in a single sentence in his 2010 memoir, No One Would Listen. The SEC is not capable of finding ice cream in a Dairy Queen. Next time on Empires of Money, Lehman Brothers, $613 billion, the 158-year-old investment bank that nobody saved.